Now moving on to the next concept, financial goals of a firm. Now financial goals of a firm may be stated as maximizing long-term as well as short-term profits and minimizing the risks. This is the most important financial goal of a firm. The most important financial goal of a firm is what? Maximizing long-term and short-term profits. As much as possible, they want to maximize the profit. Here profits does not mean profit maximization. Here profit means combination of generating cash and also trying to earn as much as possible. That is, keeping in mind the wealth maximization objective and the cycle of the cash should flow in the business. That is what is the main objective of a company or main goal of a firm. This is what is also called as financial goals. And financial goals may be stated by doing what? Maximizing long-term as well as short-term profits and minimizing the risks. By minimizing the risks and maximizing the long-term and short-term profits, company can make sure that their cash is also flowing and in long terms they are able to generate profit also. So these both factors are going to relate to the profit maximization as well as wealth maximization objective. Is it clear with everyone? Understood everyone this part? Great, superb. Let us now move on to the next concept, that is management versus owners. Who are the management people? The people who are appointed by the shareholders. And who are owners? The shareholders themselves are the owners. Now management versus owners, there has been some combination or some kind of reflection. Management versus owners, the management role is to maximize owner's interest. And what is owner's interest? Owner's interest is to get more and more dividends. The prices of the shares should go up. So in other words, management acts as satisfier for owners rather than maximizer of the firm. Again I repeat, what is basically the role of management? The role of management acts as satisfier rather than maximizer of the firm. Management has to satisfy whom? The management has to satisfy the owner and not the people or not the activities. Management role is to satisfy the owner. This gives, this brings a new broad line, or this brings a new kind of an concept which is more or less what? Moreover known as what? The wealth maximization concept. The wealth maximization concept only can satisfy the owners, because wealth maximization objective can bring cash at the same time generate profits in the market. That is what wealth maximization objective is all about. So under management versus owners, management acts as satisfier for owners rather than as a maximizer for a firm. Now after listening this much part, I am going to ask you 3 or 4 questions. You have to quickly jot down the questions and help me to understand what those questions are. There is a small reference round taking up at this particular level. So I will ask you questions and you have to answer the questions thinking that this is your exam, so that I understand that you have understood this concept properly or not. So the first question coming up to you is that the traditional times finance manager role was more complicated or modern times finance manager role was more complicated? Whose role was more complicated? First is traditional managers roles were more complicated, or the modern finance manager roles were more complicated? What is the answer? Please note it down in the book. Great. Moving on to the second question. There are 2 objectives of financial firm, or financial objectives of a company are 2. Which are those 2? I am giving you 4 options. You have to think and tick on the correct one. The first is profit maximization. The second is wealth maximization. The third is none of the above, and fourth is both of the above. Which is the financial objective of the firm? I believe you would have done that. Moving on to the third question. The profit maximization objective revolved around which concept? First is profit to sales ratio. Second is something which is known as profits pure, and third is known as return on investment. On which point profit maximization objective revolves? I believe you would have ticked to the right answer for this particular part also. Moving on to the fourth question, the last question. The wealth maximization objective focuses on cash rather than profits. Is it true or false? Is it true or false? I believe this exercise you would be able to do if you have listened the first part properly and clearly. The first answer is that in the traditional times, finance manager role was more complicated, or modern times role of finance manager was more complicated. The correct answer is what? The traditional times finance manager role was not that much complicated as compared to the modern times. So the correct answer for the given question is going to be modern times finance manager role was more complicated and complex. The second question revolved around what kind of objective of a firm was. Was it profit maximization, wealth maximization, both of the above or none of the above? Which is the correct answer? The answer is both of the above. This both of the above were the objectives of the firm throughout the business cycle. That is, they want to earn profit, at the same time they want to earn wealth. The third, profit maximization revolved around what objective? The profit maximization objective was profit to sales ratio, or return on investment. Which was the correct answer? The correct answer was all of the above. That is, the combination of all of the above was the great answer. And last is wealth maximization objective follows more cash rather than profits. True or false? The answer is true. Yes, the wealth maximization objective revolves more around what? The cash rather than profits. That's great. If you have been able to understand till now this much part, you are in a right frame of mind getting the idea about what is financial management. Thus, let us now move on to the next aspect of financial management, which revolves around social objectives. These days, a lot of companies focuses on social objectives of a company. That is more easily termed as corporate social responsibility. Company's corporate social responsibility is a transformation wherein the corporates focus on the society rather than on themselves. Lot of companies which are earning profits, they think about the society. Society belongs to the nearby activities what they do. The company proves that in the long run, they want to focus not only the economic activities of the business but also social objectives are mutually beneficial. That is, improving social environment of workforce, wherein they are going to focus on making sure the employees have got good amount of housing facilities, the employees have got their children going into good schools, building up of hospitals nearby their surroundings is what is the social objective a company usually follows. There are many companies in the world over which has made sure the focus is on social or societal objectives. Examples like companies in India, we have got examples like Tata, which has built up their own base or own background from where they have built up. That is Jamshedpur. They have developed Jamshedpur. Similarly, Reliance, which is a very big company in India, has been able to develop from where they had begun. That is Jamnagar. There are a lot of people, politicians, which have made sure that they focuses on social objective of the company. That is focusing for doing something towards the society. That is where the social objective is also very, very, very important. Now moving on from where we had left in the last slide, that is after seeing the social objective, now let us move on to the understanding of concept financial management. That is the term finance. The term finance, as in the start of the lecture I had asked, what is accounts and what is finance? Now we are going to see hardcore what do we mean by term finance. Finance means acquiring funds on reasonable terms to pay bills and other obligations promptly. So we'll acquire funds in some or other easier or reasonable terms so that we can pay it back to the company. The most important meaning of term finance means multiplication of cash. Remember, whenever we mean by term finance, it is more related to what? Multiplication of cash. Let me give you here an example of comparing and showing you what do we mean by term accounts and what do we mean by term finance. As I told you, accounts was more related to bookkeeping or recording of transactions, and finance is more related to multiplication of cash. For example, there are two members. One is Akash and second is Akshay. Akash is in the company and he is working as maybe basically as an accounts manager, whereas Akshay in the company is working as finance manager. Now Akash, who is an accounts manager, the boss gives him 10 lakh rupees. His role is to make sure he records all the transactions. boss comes to him and tells him that I have spent today 1 lakh rupees towards buying or booking a particular promotion advertisement on television. Then the director again goes to Akash and tells him that we have recorded an expense for booking up a tea party happening for company's success. So Akash is going to do what? He's just going to record the transaction. Whereas Akshay, who is more responsible for as a finance manager, when 10 lakh rupees is given to him as a finance manager, what is his role? To convert 10 lakhs to 15 lakhs. That is to multiply the cash. It is going to be done by whom? It is going to be done by the finance manager. That is multiplication of cash. That is what is the concept of financial management. That is, the focus is shifting from just recording of transaction to multiplication of cash. Great. Moving ahead, finance also, or finance manager also does the activities of procuring of funds. That is also termed as modern approach to finance. So finance as in is basically multiplication of cash, allocation of funds in proper place, then procuring of funds and making sure that they can multiply the cash is what is responsible of financial manager or finance manager. To sum up, the modern approach of finance can be shown in this particular diagrammatical format. On the left hand side you can see the funds source, that is from where the companies can get the funds or where the finance manager focuses for funds. The finance manager get funds from internal cash flows, that is from operations, that is doing business day-to-day activities. Then external debt, that is borrowing from market. The company can get in funds either by issuing equity to companies, that is issuing equity in form of shares to individuals, to institutions, other firms and government. These are the place from which companies can get in funds. Whereas where funds can go out in areas where outflows can happen, that is asset expenditure in format of current asset, fixed asset, and also money can go out in applied to non-asset expenditures like labor, material, interest charges, profit distribution to owners and etc. things. Okay, now we are seeing the concept of financial management, that is the term finance. Finance means acquiring funds on reasonable terms to pay bills and other obligations promptly. So if we have to acquire funds and pay the bills promptly on time, that is what is meant as term finance. But usually term finance means what? It means multiplication of cash. Also, term finance is also referred to as procurement of funds in modern approach to apply the funds in proper way. That is what is finance all about. Now to give you a brief idea what is finance, let me give an example by explaining you the concept on the background, in the background of accounts. There is a concept which is known as account and there is a concept which is known as finance. Accounts means what? Accounts means recording of transactions, and whereas word finance means multiplication of cash. The term accounts where we are going to record the transactions, and term finance where we are going to multiply the cash. I am going to give you an example and explain to the term accounts and finance in proper manner. Now there are two people working in the organization. First is going to be maybe Mahesh and second is Suresh. Now Mahesh is an accounts manager and Suresh is finance manager. The accounts manager Mahesh, his responsibility is to allocate the funds in proper way in the books of accounts. The boss comes and gives him 10 lakh rupees and the boss goes and gives 10 lakh rupees to Suresh. When he gives 10 lakh rupees to Mahesh, Mahesh's responsibility is to record the transaction in books in proper manner. Mahesh does what? Whenever 10 lakh rupees is given to him, all the expenses, all the outflows, whatever is going to happen, it is going to be recorded in proper manner in the books. Whereas the money which is given to Suresh, his responsibility is to multiply the cash from 10 lakh to 15 lakh rupees. That is, he is going to multiply the cash as much as possible in the market. This multiplication of cash is nothing but known as word finance. The term finance now, which is being given in the format of sourcing of funds and applying of funds in proper manner, can be seen with the help of a following diagram. Now the sourcing of funds, on the left hand side of the screen is the place from where we can source the funds or from where the funds will be coming in the business, that is inflows. The company can get fund in the business either from operations. Now what do we mean by operations? Day-to-day activities which we are basically producing the goods and selling the goods. From these places we will get the funds. Also, the funds can be brought in the business from external debt. What do you mean by external debt? That is borrowing from the market. Either by, say for example, borrowing from banks, borrowing from friends, family, relatives, issuing debentures in the market. These are few concepts from which we can get the funds in the business. Similarly, we can get funds in the business from our own funds. Own funds means what? It is going to be our owner's fund, that is our own capital. We can get funds from our own place, that is it will belong to the business, from individuals, from institutions or other firms, also sometimes from the government. The funds are going to go out in form of outflows in different areas. Funds will be used, which is collected by the company, in areas like current assets and fixed assets. Also, we will be having a concept which is known as non-asset expenditures. That is, funds may also go in non-asset expenditures like labor charges, material charges. Then we have got interest charges, profit distributed to owners. These are the places where funds would go, and these are the places from where funds are going to come in. A finance manager role is to manage not only these activities, but also to make sure he can multiply the cash for the business. This is what modern times finance manager activity is. Now, after seeing the concept of financial management or understanding what is exactly the term finance, we are now going to go into the activities in which what is the traditional times finance manager activities and what is the modern times finance manager activities. Now, seeing the traditional concept of finance function, the traditional times finance manager determines fund requirements, finds most economic source for them, and timing of acquiring and disposing of funds was considered as the real scope of financial management. So what is the real scope or use of financial management in the traditional times? In the traditional times, the real scope or use of finance manager was determining funds required. How much funds is required? It would be determined by the finance manager in the traditional times. Then what is the most economic source where I can get the funds in the most economic way is going to be the next activity. And then timing of acquiring that funds, which is the right time to acquire that funds and which is the right time to dispose those funds. Dispose means what? Use that fund sometimes, or sometimes give the money back to the people from whom I have basically brought the funds. This is basically sourcing related activities. That is what traditional times finance manager role was. Next is allocation of funds for different assets, monitoring them to optimize use of non-financial executives. So allocating those funds, where I have got the allocation of funds for different assets, monitoring them to optimize, monitoring them how I can maximize the benefit, was considered to be in the scope of non-financial executives. So just sourcing part was done by the traditional finance manager, and allocating those funds which can generate more returns, more value, was the activity of what? Non-financial executives. So non-financial executives were more responsible for allocating the funds, and the finance manager whose activity was to traditionally in the traditional time just to source the funds. This particular concept gave rise to corporate finance. I repeat, the traditional concept of finance function focused on corporate finance and ignored his responsibilities and role in managing of non-corporate firms, partnerships, trading concerns, etc. So the finance manager in the traditional times, he used to do the activities of just corporate finance. Now what do I mean by corporate finance? Corporate finance means bringing the funds and allocating the funds in proper manner. What the funds had been brought from and what was the use of that funds was a traditional concept, and this was properly being taken care of by the traditional times finance manager. But the old approach considers long-term finance important and ignores finance manager skills required to tackle day-to-day working capital funding. So the old managers, that is the traditional time finance manager role, was just focused upon where the funds were coming in and for what purpose. The purpose was, say for example, to acquiring a plant. Then the traditional times finance manager would bring the funds and use that funds for bringing or building up of, say for example, plant or developing a machinery. So if a company has to import a machinery, say for example from some other part of the country, so for that this X amount of funds were required. The traditional time finance manager would arrange the funds, determine which is the cheapest source of funds and use these funds for that activities. That is basically known as corporate finance, bringing the funds for long term and using that source for the long term purposes. But the traditional times finance manager skills were not taken into consideration for managing day-to-day working capital funding. So anything which was requiring the activities of day-to-day activities was ignored by the traditional finance manager. Traditional finance manager, thus in other words, were not given responsibilities for day-to-day activities. All day-to-day activities were done by whom? It was done by the non-financial executives, and it was not in their domain where they were supposed to focus upon. Moving on from traditional concept to modern finance function. Modern finance function, which was categorized by modern scholars, were divided into two parts. Modern finance function, as per modern scholars, which were academicians and institutions in the market, they identified that modern finance function were having two activities. That is recurring activities or recurring functions, and second was non-recurring activities, which was sometimes one-time or episodic functions. So modern finance manager were having these two activities, unlike the traditional activities. Traditional finance manager focus was only in one area, that is bringing the funds for long-term purposes and using that funds for long-term purposes. Their role with regards to managing day-to-day functioning of activities were in the domain of non-financial executives. As far as modern finance function was concerned, the modern scholars, modern academicians, modern institutions suggested that the modern finance manager role was quite more extraordinarily as compared to traditional finance manager. The modern finance manager's role and function was responsible with regards to recurring function and non-recurring functions. Recurring functions were those functions which were on day-to-day basis, and non-recurring functions were those functions which were one-time, sometimes episodic functions that would happen once in a while. Let us see what are recurring functions. Recurring functions are those functions which the company has to do regularly. That is planning of funds, raising of funds, allocation of funds, allocation of income, monitoring of use of funds. This is going to go on and on. Continuously the function is going to happen. That is, what do you mean by planning of funds? How much funds is required? For what purpose this funds is going to be required? Where this funds would be used for? Where this funds would be brought in from? All these things would be the day-to-day functions of the finance manager of the modern times. And this was taken care by the modern finance manager. Earlier in traditional times, this function was ignored, and this function responsibility was given to the non-financial executives in the traditional times. Whereas in modern times, this function is the most important function of finance manager. They would do activities with regards to planning of funds, then raising the funds from the market, either from debt related activities or from equity related activities. Then allocation of funds. These funds where should be used for? Then allocation of income. When the income was generated, where they are going to give this income. And next is monitoring the use of funds. How they are going to use the funds. Monitoring of all these funds was basically the recurring function, that is regular function of the finance manager. Now the next slide is non-recurring functions. Non-recurring functions means the functions which the finance manager has to do once in a while. Episodic functions. Once in a while he will do these activities. The non-recurring function comprises of a finance manager, relates to preparation of financial plan, financial readjustment, valuation of enterprise and reorganization of enterprise. Here the finance manager will be responsible for doing activities which is once in a while, that is episodic. Every company's finance manager does not do these activities. The finance manager would do these activities sometimes, not regularly, and hence it is classified as non-recurring function. At times, the finance manager has to value the company because he has to get its company merged with some company, he has to take over some other company, he has to value for making a project report. So this is going to happen once in a while and not regular basis. These are few non-recurring functions of finance manager. Now based on this, what I have explained to you all, my next question to you all is that if a traditional finance manager is there and if a modern finance manager is there, so based on this I am going to ask you one question. The question is, the traditional finance manager role is to do the activities of sourcing funds, allocating of funds and managing day-to-day finance. What do you think, that is this a statement true or false? I'll again ask you a question. The question is, the traditional times finance manager sources the funds, allocates the funds and manages day-to-day finances also. The answer is what? True or false? Yes, I am asking to you question. The answer is what? It is false. Absolutely correct. Because the traditional time finance manager does what activities related to corporate finance, which is sourcing of funds and just allocation of funds. The funds which they are supposed to maintain for day-to-day activities is the responsibility of whom? It is the responsibility of non-financial executives. Correct. It is the responsibility of non-financial executives. So the modern finance executives activities is related to what? It is related to not only just sourcing, allocating, but they are having dual responsibility. The dual responsibility is recurring function, at the same time non-recurring function. This is basically felt by modern finance academicians, institutions and modern scholars. Now, moving after seeing what we have seen now to the next point, that is scope of financial management. Where we can use financial management. Financial management can be used in different areas. Financial management is very wide. It is very broad. It starts from inception of the company to its growth, then moves on to expansion and eventually winding up. At all these places, finances are going to be managed or it is going to be used. That is right from starting. When the company is going to start up the business, it requires to manage the finance. Then moving on from that particular level to the company when it is going to grow, expand and then wind up. At all these areas of the junction of the business, a finance manager has to use financial management activities. This is not only true with business, it is also true with us, that is individuals. That is right from the birthplace, when we are born, then when we grow up, then we grow up to a level where we are going to have a situation where the company is going to, individuals are going to grow up in life, start up their own business, then they have to manage finance for their own self. Moving to a situation where the business when they are going to do, for which they will require finance, day-to-day activities, growing up their children's. For all these purposes, finances are going to be used. Financial management covers decisions areas related to investment, financing and dividends. So these are three areas which are going to be covered by financial management. Investment. Now what do we mean by investment? What do we mean by word financing? And what do we see the area where financial management would be used? Is dividends related activities. So financial management would cover areas related to investment, financing and dividends. Now investment, decisions areas of investment. Financial management with regards to investment would take care of two different parts, that is long term and short term. Long term investment decisions relate to allocation of funds to projects whose benefits accrue over a long period. So the use of financial management can be taken care of at this level, wherein long term decisions, where the money would be brought in for long term purposes, where this money would be used for long term purposes, is the area where financial management investment related activities would be done by a finance manager. Similarly, for short term investment decisions, finance manager decides how the funds are distributed over cash or cash equivalents, receivables and inventories. So for short term purposes, finance manager would be responsible for acquiring funds for short term purposes and using these funds for short term purposes. So financial manager is responsible for both the activities, that is long term investment related activities and short term investment related activities, which comprises of long term investment versus long term sources and short term investment for short term sources. So all these or both these functions would be responsible for investment related activities. In other words, the main issue is to trade off between profitability and liquidity. This is what is the finance manager use of the term investment as far as considered. So use of financial manager is going to use its skills for managing the finance at three different levels. First is at investment level. He will be responsible for investment level with regards to long term and short term.